Every time you open a retail brokerage app and tap buy for a quick day trade, you're engaging in a mathematical guarantee of financial ruin. Social media is saturated with influencers posing in front of rented sports cars, insisting they possess a secret formula for beating the market. But the actual data tells a different story. When economists analyzed the trading records of 450,000 individuals over a 15-year period, the reality of the market became impossible to ignore. They found that a staggering 97% of day traders who stuck with it for over 300 days lost money. This massive failure rate stems from the structural trap of retail day trading, which operates with the exact odds of a rigged casino while being engineered to look like a legitimate investment vehicle. The attrition rates reflect this reality immediately. Roughly 40% of beginners abandon day trading entirely within their very first month. Within 2 years, 80% have walked away. By year 5, only 7% of those original traders remain active. This handful of survivors represents the small group that absorbed their losses and finally stopped playing, rather than successful traders retiring with their profits. Massive datasets out of Taiwan and Brazil track this persistence. They show that unprofitable traders continue executing trades despite extensive multi-year histories of losing. Researchers reviewing the data concluded that trading to learn the market is mathematically equivalent to playing roulette to learn the casino. Continuing to participate in a system with a negative expected value indicates a behavioral bias or gambling addiction, not professional development. A primary driver behind this slaughter hides in the invisible math of the trade itself. Every single transaction carries friction, a guaranteed tax made up of broker commissions, slippage, and the bid-ask spread. Because of this friction, predicting a stock's direction correctly half the time guarantees you will lose your capital. You have to be right roughly 55% of the time just to break even against these ongoing fees. For highly active day traders, these microscopic costs compound aggressively. Executing dozens of trades a day multiplies the friction, bleeding an account dry through thousands of tiny cuts without generating any actual trading edge. The house edge in the market resides within the mechanics of execution, regardless of the stock's final direction. Those execution mechanics are dominated by institutional high-frequency trading algorithms. These supercomputers process and execute thousands of orders in a fraction of a millisecond. They deploy tactics like ghost liquidity, placing massive buy or sell orders that instantly vanish the moment a slower participant tries to interact with them. By the time a retail trader clicks a button, the algorithm has already detected the incoming order, reacted to it, and extracted the value. This chart shows the Dow Jones Industrial Average during the May 6, 2010 flash crash. HFT algorithms reacted to market stress by rapidly withdrawing liquidity, creating a mechanical feedback loop that wiped out $1 trillion of value in minutes. A retail trader staring at a smartphone screen is bringing human reflexes to a millisecond precision battlefield entirely controlled by machines. Even if a retail trader could outpace the algorithms, their own biology works against them. Humans are hardwired with loss aversion, meaning we experience the psychological pain of losing money twice as intensely as the pleasure of gaining it. This biology creates a trap known as the disposition effect. Data shows traders sell winning positions 50% faster than losing ones. They are actively watering the weeds and cutting the flowers, desperate to secure a small win while refusing to accept a painful loss. When the losses inevitably mount, the brain panics and attempts to win the money back quickly through rapid overtrading. Statistically, this emotional reflex causes the most active retail traders to underperform the broader market by an average of 7. For every one highly visible trader posting massive gains, there are hundreds of thousands of silent, invisible failures who quietly blew up their accounts. The success of the 1% is used as bait to trap the 99% in a cycle of overconfidence. There is a mathematically proven way to beat a rigged casino. You simply turn around, walk off the floor, and stop playing their game. Instead of joining the 97% of active traders who slaughter their own wealth, an investor can capture the market's natural upward drift by buying a broad index fund and simply doing nothing. Stop paying fees to participate in this slaughter. Choose the slow path of passive investing.